Right now, while you are watching this, your bank account shows a number. And that number feels real, it feels safe, it feels like yours. It is none of those things. If every person in your city walked into their bank today and said, "Give me my money," the bank could not do it. Not because something broke, not because someone stole it, but because the system was built this way, on purpose, and nobody told you. The moment you deposited your money, something quietly happened that no banker will explain at the counter. You stopped being a customer. You became a lender. Your money is not sitting in a vault with your name on it. Legally, the second it crossed that counter, it became the bank's money. You became a creditor. The bank became your borrower. And that balance on your screen, that is not cash. That is a promise, a number they owe you. Nothing more. Let that sit for a second. Here is what they did with it. They lent it out, almost all of it. Under fractional reserve banking, banks are only required to keep a small fraction of your deposit available at any time. And in March 2020, the United States quietly dropped that requirement to 0%. Zero. No legal minimum, number, floor. Your deposit walked in the front door and went straight out the back as someone else's mortgage, someone else's car, someone else's debt. And here is where it stops being uncomfortable and starts being absurd. That loan becomes a deposit in another bank. That bank lends most of it out too. The same money moves through the system again and again, each cycle creating new purchasing power from nothing. $1 enters, $10 exist in the economy. None printed, none earned, just lent, and lent again, and lent again. Economists call it the money multiplier, but if you saw it drawn on paper, you would call it something else entirely. You might be thinking, fine, but my money is insured. And you are right. In the US, the FDIC covers up to $250,000. That guarantee is real. But here is what the fine print does not say out loud. The FDIC fund holds roughly $1 for every $100 it is supposed to protect. The safety net exists, but it was never built for a real fall. The actual backstop is the government's ability to borrow more, print more, and hope the belief holds long enough to stop the panic. The system does not run on capita. It runs on trust. And trust, as history keeps reminding us, is the most fragile currency of all. This is not a new invention. 300 years ago, English goldsmiths figured out that people rarely came for all their gold at once. So they started issuing more receipts than they had gold. It worked beautifully, until the day it did not. People panicked. They came all at once. The gold was gone. That was 1696. We rebuilt the same system. Added insurance. Added central banks. Added regulations. Layered complexity on top of fragility, and called it stability. And then in March 2023, Silicon Valley Bank collapsed in 48 hours. Not fraud, not corruption, not some hidden conspiracy. Just too many people asking for their money at the same time. A completely normal request. A catastrophic result. Gone in 2 days. The 16th largest bank in the United States, and it took less time to collapse than it takes to plan a weekend trip. The whole system, every mortgage, every salary deposit, every savings account, every pension, rests on a single invisible assumption that you will not ask, that you will look at that number on your screen, feel safe, and walk away. And for the most part, right, you do. We all do. But somewhere in the back of your mind, a question is forming now that was not there before you clicked on this video. And that question, quietly, slowly, is exactly what the system has always been afraid of.